financial advisor since 1992. Investing does take time, education, observation, success, and failure to find a discipline and a strategy that will lead you to long-term success. Said another way, successful investing is a marathon. It's not a sprint. It's extremely beneficial to be aware of the stock market history to help avoid some of the miscalculations of the past and to prevent you from repeating other people's mistakes. My goal is to help you minimize how others have blundered and avoid failures that are unrecoverable. Let's discuss talking heads. That's the assortment of pundits that are on TV and the internet that, quite honestly, they'd be out of a job if they actually told you the truth. You see, their job security is based on you thinking that they have some type of insight into the latest stock, the latest trend, the next earning report, the consequences of the next Federal Reserve meeting. And all of this has nothing to do with you becoming a successful long-term investor. Just read the headlines that boast my top stock picks for 2025, the next Amazon, or the hot industry that you must be invested in. You want to do a fact check on that? Just write down what you're being told today and then see how that turns out 6 months or a year from now. Let's talk about the opposite of conventional wisdom, which through fear is buying at the top. The second mistake is selling at the bottom. That's where you have a lot of emotion and fear going on. And you're thinking, I have to get out. I'm going to lose everything. And I would caution you not to let emotion, that's both greed and fear, control your decisions. Anytime you think about selling a holding, it creates 3 subsequent decisions with critical implications. The first one is at what point or price are you going to sell? The next one is at what point are you going to reinvest that money? And then obviously the third one is what are you going to buy? Let's use some history to illustrate the challenges and consequences of this mindset. And we'll go back to the market decline starting in 2008. The high point of the S&P 500 in 2008 was in August. It hit 1,300. And then just 6.5 months later, we hit the low point. It was March 2009 when it dropped to 676. That's a 52% drop in market value. So, did you or would you stay invested? Did you sell at some point as values continue to drop almost daily? And then there's the worst scenario, and those that just could not take it anymore, and they liquidated either close to or at the bottom. I mean, think about it. $250,000 dropped to $120,000. That's tough to stand by and take. But by June of 2011, we were back above 1,300. So from the time that it hit its lowest point to back to the previous high, which is 27 months. So in retrospect, was there any benefit of getting out of the market in 2009? And history will show there was no benefit. And there were also those investors, because they did sell at the low point, they never got back into the market. They felt they had been burned. For those that decided to play it safe in 2009 by moving to and staying in cash, by August of 2020, the market had skyrocketed to almost 3,400. That's an increase of 500%. Now that's the real consequence of letting your fears get in the way and making emotional decisions with your money. Another investor mistake, it's trying to time the market. In investing, the term random walk, it refers to a well-known theory that stock prices, they move unpredictably and randomly, meaning that any past price changes cannot be used to accurately predict future price movement. This is the theory that's often used to support a buy and hold investment strategy. And one thing that we've seen over the last 100 years of the stock market is that we do have temporary declines and permanent advances. And those that think that they can get in and out of a market and make money, they've got 2 decisive decisions. The first point is, when do you take your gains? Would it be after appreciated 50%, after it went up 100%? And then the second one is, where are you going to reinvest this money now? And the risks that you take when you think that you can outsmart the market, they're endless. So let's discuss the philosophy that will serve you well over the long haul. And I'm talking about individual stocks. And clearly, stocks are not for everyone, but those that are willing to complete the initial due diligence up front, the rewards can be substantial. Number one, you need to understand the nature of the business of the stock that you're considering. Meaning, what is it that they do and what are they known for? I would avoid industries and companies that you do not fully understand. Next, look for market leaders that have a long history leading their industry. The company should have several competitive advantages, a margin of safety for investors, global name recognition. Are they innovators? Are they creating new products? Are they expanding their offerings or their services? They should have strong customer loyalty. And lastly, but not limited to, evaluate the business. Look at the strengths. Do they have strong economics, solid balance sheet, high net profit, consistent growth? And I'm guessing that you could probably make a list of a dozen of these companies that fit that criteria within 1 minute. Do that immediately after watching this video. Now, once you've identified potential companies, you need to complete your own due diligence. Look at industries that are not cyclical. And it's okay to focus on specific industries that dominate, such as technology. I would limit your holdings, as it's not uncommon to focus on 10 holdings or less. Select companies that you feel you can potentially hold for decades. And obviously, things can always change. But this should be your mindset in the selection process. If in any given year, the value of a holding decreases, does that stock price change your attitude towards the company? Most likely it will not. Just ask yourself, do you believe that within the next 5 years it will not far exceed that current value? And so if the answer is yes, then invest more at an obvious discount. It's often buying on the dip. So let's put all this together to connect the dots. Commit to investing in the long term. Realize that advances and declines happen daily. The market has internal and external factors that affect the outcome and are out of your control. Most investor fortunes are made over decades. Do not overestimate your ability. Money that's easily made is often easily lost. Hold quality investments, earn downtimes, as mentioned above, buy more, and do not sell. Through the miracle of compounding, your portfolio doubles. Getting to $1 million may take 23 years, but getting to $2 million is only 7 years after, and $4 million 7 years after that, based on the S&P history. Warren Buffett said investors need to do very few things right as long as they avoid the big mistakes. And so the lesson learned is that greed will create big mistakes. Just don't be tempted. Gordon Gekko, it was wrong. I want to thank you for joining me today. Please like and subscribe for future insight and make it a prosperous day.